Hey there, realtors and clients. It's Scott Groves and Dallas Skinner. Wanted to go through this rent versus buy comparison as I'm recording this in early 2022, actually April of 2022. Property values continue to skyrocket at the same time that interest rates are getting more expensive, inventory is getting low, and a lot of consumers are frankly giving up. And I get it. It's a tough time to buy a house. It's a scary time to buy a house. Anybody got pre-approved who got pre-approved last year in 2021 was mentally prepared for a rate and a payment that was much lower. And I want to use a specific example. This is a house that's currently under contract in one of the neighborhoods we service. It's Altadena, California. Property was listed at $899. I actually had 4 different clients make offers on this property because it's pretty unique. It's pretty special. It is a smaller 2-bedroom, 1-bath right outside of LA, but just really amazing property grounds. I know the listing agent by chance. And although I don't know for certain what it sold for, in talking to several of the realtors involved and knowing what the offer price was on my clients who didn't get their offer accepted, I think this sold at about $1.2 million. So $1.2 million for this property seems scary, but there's a lot of stuff going on in the marketplace, whether it's inflation because both political parties just printed, half the money in circulation over the last couple of years, whether it's formation of new families and, the Gen Xers, the Gen Ys, the millennials waiting until later in life to make big life decisions like have kids, have a family, get married, buy houses. That's creating a lot of upward demand, which of course then creates more price pressure. And of course, in Southern California, they're not building a whole lot of houses. So you take inflation plus more demand plus lower supply. And I don't see anything on the radar that looks like prices are going to be going down anytime soon. So let's use kind of this crazy scenario, a house that was listed for $899. Let's assume it sold for somewhere around $2 million. And let's just do the math, right? Not get emotional about it, not see what we think we should do anecdotally, but what does the math show, right? So let's say we did $1.2 million purchase price. And we got to put in some assumptions here. So first, let's put in the rental assumptions. Now, this calculator is saying that in Los Angeles County, in this neighborhood, to get a similar sized house or apartment, you'd probably be somewhere around $4,000 a month. I think that's fair. So let's actually drop this a little bit to $4,000 a month. Renter's insurance. I was a renter in the past. I know in Los Angeles County, it is expensive to get renter's insurance. Ends up running you about $100 a month. And now this is an interesting calculation that's going to play pretty dramatically into whether or not it makes sense to buy this house or continue renting. The national average right now is rent renewals are up 7.8%. And I know LA tends to be higher than normal, but let's just use kind of a worst case scenario, or for this assumption, kind of like a worst case scenario on rents, as far as like, all right, they're not gonna beat the national average. They're not going to be 3.9. I would say, in California, let's just say we get really lucky and rents only go up by 3%. I think that's super, super generous. I know places in Los Angeles, California, where rents are going up by 5 or 10%. But let's say the rent moratorium, the restrictions, things stay in place where, landlords are going to have a hard time raising rents in the county of Los Angeles. I don't think that's the case, but let's use some generous assumptions to see if it makes sense to buy. This is going to be our Altadena house that we're thinking about buying, Altadena. We know that it's going to be $1.2 million was the price that I used in our example. Now, like everything in California, the cost for taxes is a little bit more expensive. It's about 1.25% in LA County. The nice thing is we don't have floods and tornadoes and hurricanes in Los Angeles, so homeowners insurance tends to be a little cheaper. You could probably even get homeowners insurance for less than $200 a month. But let's just use that on the high side. Now, this is nice. Annual tax increase. One of the nice things about Prop 13, which was in LA County, is that property tax increases are capped. I think it's actually capped at below 1%, but let's just say property taxes in Los Angeles. That's one of the nice things that the county government or the county and city government do here is property taxes once you buy, they're effectively based on your purchase price and they don't go up dramatically like they do in some other areas like Texas, for example. Homeowners and repairs, there are no HOA dues. Maybe you throw $200 a month at repairs leaky faucet, save for a couple of years, and then you got to replace the garage door for $1,200, $2,000, whatnot. And I know in Southern California at this price, the cost to sell is closer to like 5%, maybe even lower than that, because realtors tend to get 2.5% on each side of the deal just because our purchase prices are higher. Now, let's go with the loan. We'll go with a conventional 30-year fix. So let's say you put 20% down and 30-year conventional fix, this interest rate. Let's just say the interest rate was even higher. I don't think that's going to be the case, but let's just say it is. There's no mortgage insurance, and this closing costs a little high at $24,000. With your taxes, your prepaid interest, your escrow, your title, your appraisal, your inspections, this is going to be closer to about $12,000. And home ownership. Let's say you're not even going to stay in the house for 9 years. Let's say you're going to stay in here kind of the California average about 7 years. We'll use the historical appreciation rate, not the forecasted appreciation rate, because let's say, even though we're forecasting appreciation rates in Los Angeles, which I think is very much calculated to the low side here because we're just seeing so much inflation. But let's use an even lower number, 5.6. So we're using kind of all of the worst case calculation numbers for, are we going to make money by being an owner versus a renter by, remember, quote unquote, overpaying by $300,000 on this house, right? That's a scary number that will force people to just say, no, this market's too crazy. I'm out. I'm just going to keep renting. So let's kind of use like all the worst case scenarios here, right? Now, this is interesting. This is one thing that I am willing to change because the state tax rate in California, the income tax rate in California is one of the highest, I think, in the country. So if you can afford $1 million house, you're probably somewhere in here in the 32% tax range. And then you've probably got about another 4 to 5% in state taxes that you're paying, overall, even though it's a graduated scale. Let's say overall. So let's say, if you can afford $1 million house, you're probably about 35 cents on every dollar you make going to the government at some point. And let's just assume you're married filing jointly. You'll take the standard deductions, meaning you don't own a business, you don't own other property, you don't have anything to write off. Let's see what this comes out as. So again, using kind of all the worst case assumptions. Now, to be clear, your monthly payment up here at the top is about $6,800 a month, for your all-in cost versus your $4,100 a month for rent. So let's be very clear that this $6,800 is due to the bank every month. But as you can see, rents are also going up, right? $4,000 in 7 years, you're going to be getting much closer to what you were paying on a mortgage, on a fixed rate mortgage, for what you're paying in rent. So there is a cash flow difference, right? There is a cash flow difference, meaning money out of your pocket is going to be going towards mortgage, taxes, insurance, repairs. You, quote unquote, spent an extra $200,000 by being a homeowner versus a renter. But look what happens if the historical appreciation stays at 5.6% and you pay down your 30-year fixed mortgage, right? And you calculate in your cost to sell, you are richer 7 years from now by $451,000 because you decided to be a homeowner versus a renter, right? Now, let's make some other assumptions. Let's say, hey, Scott, you know what? I think inflation is going to cause a major recession, and we are going to see appreciation drop dramatically, right? Where we're going to see we're going to see taxes go up. We're going to see appreciation go down. We're going to see a lot of crazy stuff, right? So let's use a custom appreciation rate. Let's say appreciation only goes up 2% a year, right? Okay, fine. And let's say you're only going to be in the house 5 years, okay? And that this recession comes and it just completely breaks the back of the economy and there's very little appreciation in the housing market. Well, guess what happens when that happens? You're also going to have interest rates go down, right? So when there's a recession and there's a flight to safety in the mortgage bonds, the treasury bonds, that's what creates the environment for rates to go down. So let's say you could refinance at 3.75 a year or two from now. So it sucks because property values aren't going up as quickly. You're a little scared because we're in a recession, but at least it gives you an opportunity to refinance, right? Well, what happened in the recession of 2008, 2009? What happened in the recession was when people weren't buying houses and or losing their houses, they had to go rent. So rent actually went up. If you remember 2007, 2008, 2009, as people were losing their house, rents actually went up. So you can't just move these levers without thinking about how the other levers would move. So let's go back to like a 5% increase in rent, right? So rents went up a little bit, rates went down a little bit, but your appreciation basically bottomed out. Like you're not even keeping up with inflation, which is highly unlikely, because there's very few times in the history of housing where that's happened. But let's just assume worst case scenario. And oh, by the way, your job transfers you, so you can only stay in the house for 5 years instead of kind of the national average 7 or 9 years. Does it still make sense to buy versus rent? Well, yeah. You're out almost $100,000 in cash flow difference, right? Your monthly expense is still much higher than it's going to be in 5 years because you're a homeowner. But not only do you have appreciation gain at that 2%, and you'll see in 5 years this house is presumably worth about $1,325,000 versus $1,200,000, but you also paid down your mortgage, because remember, part of this monthly payment is a fixed rate interest that's paying down principal and interest. So you're paying down your principal, right? So your house is going to be have a smaller loan when you go to pay it off. Plus, you had about a $33,000 tax advantage. So even if you're only going to own the house 5 years, and appreciation is going to fall off a cliff, which I don't think it's going to due to inflation, you still are going to be $80,000 richer 5 years from now for owning a home that you bought $300,000 over the asking price versus being a renter. And anytime you've read Rich Dad, Poor Dad, or you've heard, Susie Orman or Dave Ramsey talk, one of the best ways to build wealth in America is to be a homeowner, and it's because of this. It's because of the fact that you're gaining in appreciation, you're gaining in amortization by forcing yourself to pay down the principal every month, and there's a tax benefit for being a homeowner versus a renter. So if you need to see something like this for yourself or one of your clients, if you're a realtor, let me know, because I think it's very easy to get emotional about a property and be like, oh my God, I'm paying $1,200,000 when the listing price was $899. Yeah, that's scary. That feels kind of shitty. But when you look at what is the actual math, it might create a scenario where people want to get off the sidelines and actually buy a house instead of stay a renter. So if you have any questions, you know where to find myself in Dallas. We'd love to work with you if you're a client, or your clients if you're a realtor. And it's just important, because when emotions are high, which right now they are, political, inflation, geopolitical, what's going on with the housing market, cost of clients thinking they can buy this house for $900,000 and it's going to sell for $1,200,000. When emotions are high, intelligence is low. So this is an important time for us professional lenders like myself, like Dallas, to step in and say, hey, when emotion is high, intelligence is low, and it's important for us to bring the mathematical conversation to the discussion to realize, it's $100,000 or hundreds of thousands of dollars better to be a homeowner versus a home renter. Talk to you soon.